Welcome to our channel. Today, we're diving into a topic that can make the stock market feel like a darn roller coaster: tariff wars. These disputes can send shockwaves through global trade and leave investors scrambling. We're talking about the possibility of a full-blown trade war, folks, and that's enough to make even the most seasoned investor sweat a little. But don't you worry, we're here to break it down, make sense of the chaos, and help you navigate these treacherous waters. Stay tuned to understand the key impacts of tariff wars and what it means for your hard-earned investments. Let's get real, folks. Tariff wars and market volatility go together like peanut butter and jelly. They are inseparable, and when one appears, the other is never far behind. When two economic heavyweights start throwing tariffs around, it creates uncertainty, and the market absolutely hates uncertainty. It's like watching two titans clash, and the fallout can be devastating. Think about it like this: you're running a business, and suddenly, bam! Out of nowhere, new tariffs are imposed, and you're left scrambling to adjust. The cost of your raw materials skyrockets because of some new tariffs. This isn't just a minor inconvenience, it can fundamentally alter your business model. What happens? Your profits take a hit, and investors get spooked. They start questioning the viability of your business. They start dumping your stock faster than you can say, trade deficit. It's a chain reaction that can spiral out of control. And it's not just individual companies, folks. Entire stock indexes can take a nosedive when tariff tensions escalate. The ripple effects are felt far and wide. Remember back in year when the Dow Jones Industrial Average plunged over 500 points in a single day? Yeah, that wasn't pretty. It was a stark reminder of how interconnected our global economy is. Investors were hitting the panic button left and right because they were worried about a full-blown trade war. The fear was palpable, and it spread like wildfire. See, tariffs are like a disease. They can spread and infect the entire global economy, and that's enough to send chills down the spine of even the most fearless bull. The uncertainty they create can be paralyzing. We're talking about a real roller coaster ride, folks, with tariffs driving the market up and down like a yo-yo. One day you're up, the next day you're down, and there's no telling where you'll end up. One minute there's hope for a trade deal, and the market surges. The next minute talks break down, and we're staring into the abyss of a trade war. It's a constant state of flux. It's enough to make you want to scream, "Sell! Sell! Sell!" The emotional roller coaster can be overwhelming. But hold on a second, before you do anything rash, let's take a deep breath, and remember that knowledge is power. Understanding the dynamics at play can help us navigate these turbulent times. By understanding how tariff wars impact different sectors of the market, we can make informed investment decisions and potentially even profit from the chaos. It's about being strategic and staying informed. So, buckle up, Buttercup, because we're about to navigate the treacherous waters of sector-specific effects. It's going to be a bumpy ride, but with the right knowledge, we can come out on top. Alright, listen up, because this is where things get really interesting. We're diving into the nitty-gritty of how tariff wars impact different sectors of the economy. When it comes to tariff wars, not all sectors are created equal. The effects can vary dramatically depending on the industry. Some industries get hit harder than others, while some might even benefit from the whole shebang. It's a complex landscape where the rules of the game can change overnight. It's like a game of chess, folks. You gotta know which pieces to move to come out on top. Strategic planning becomes crucial in navigating these turbulent waters. Let's start with the losers, shall we? These are the sectors that find themselves in a tough spot when tariffs are imposed. Industries that rely heavily on global supply chains, like technology and manufacturing, often find themselves caught in the crossfire of tariff wars. These sectors depend on the seamless flow of goods across borders. Think about it. They import raw materials, components, or even finished products from other countries. Any disruption in this flow can have significant repercussions. Now, slap some hefty tariffs on those imports, and suddenly, their costs go through the roof. This can lead to higher prices for consumers and lower profit margins for companies. This can squeeze their profit margins, making them less attractive to investors. Companies may struggle to maintain their competitive edge in the market. And don't even get me started on the disruption to their operations. Production schedules can be thrown off, leading to delays and inefficiencies. Imagine waiting for crucial components to arrive, only to find out they're stuck in some bureaucratic nightmare because of new tariffs. This can lead to a ripple effect, impacting the entire supply chain. It's enough to give any CEO an ulcer. The stress and uncertainty can be overwhelming, affecting decision-making and long-term planning. But hey, it's not all doom and gloom, folks. There are sectors that can actually thrive in the midst of tariff wars. While some sectors are running for cover, others see tariff wars as a golden opportunity. These sectors can capitalize on the changing market dynamics. Take utilities and consumer staples, for example. These sectors provide essential services and products that people need regardless of economic conditions. These sectors are generally less exposed to international trade, so they're not as vulnerable to the whims of tariff wars. Their business models are more insulated from global trade disruptions. In fact, they might even become a safe haven for investors seeking stability amidst the chaos. These sectors can offer a refuge for those looking to protect their investments. Think about it. People still need electricity, toothpaste and toilet paper, regardless of whether there's a trade war raging. These are non-negotiable necessities. So these companies can keep chugging along, providing a steady stream of dividends to their investors. Their consistent performance can be a source of reassurance in uncertain times. Now, I'm not saying you should dump all your tech stocks and load up on utilities. Diversification is key, and understanding the nuances of each sector can help you make balanced decisions. But it's crucial to understand how different sectors react to tariff wars so you can make informed investment decisions. Knowledge of these dynamics can be a powerful tool in your investment strategy. Remember, folks, knowledge is power, and in the wild world of tariff wars, a little knowledge can go a long way. Stay informed, stay strategic, and you'll be better equipped to navigate these choppy waters. Alright folks, let's talk about the human element in this whole tariff war saga investor behavior. It's a fascinating and complex topic that can really help us understand the market's ups and downs during these turbulent times. See, when the trade winds start blowing in the wrong direction, investors tend to get a little jittery, and their actions can have a ripple effect on the entire market. This jitteriness is often driven by uncertainty and fear of the unknown, which can lead to some pretty dramatic market movements. Think about it like this. You're at a party, and suddenly, someone yells, "Fire!" Even if there's no actual fire, the mere shout can cause panic. What happens? Chaos ensues as everyone rushes for the exits. People start pushing and shoving, trying to get out as quickly as possible, often without even thinking about whether there's a real danger. It's the same thing in the stock market when fear takes hold. Investors start dumping their riskier assets, like stocks, and flock to safer havens like gold and government bonds. This mass movement can cause significant drops in stock prices. Investors start dumping their riskier assets, like stocks, and flock to safer havens like gold and government bonds. They do this because they want to protect their investments from potential losses. They figure, hey, even if the world goes to hell in a handbasket, at least my gold will be worth something. Gold and government bonds are seen as safe bets during times of uncertainty. Now, this mass exodus from the stock market can create a self-fulfilling prophecy. As more investors sell their stocks, prices drop even further, fueling the panic and leading to even more selling. It's a downward spiral that's hard to stop once it gets going. As more investors sell their stocks, prices drop even further, fueling the panic and leading to even more selling. This can lead to a market crash where stock prices plummet and investors lose significant amounts of money. It's a vicious cycle, folks, and it can turn a minor trade spat into a full-blown market meltdown. The fear and uncertainty can spread like wildfire, affecting not just individual investors but entire economies. But here's the thing. When everyone is running for the hills, that's often the best time to be greedy. This is a principle that some of the most successful investors, like Warren Buffett, have followed for years. See, when fear drives the market down, it can create some incredible buying opportunities for those brave enough to stomach the volatility. Stocks of fundamentally strong companies can be bought at a discount, setting the stage for significant gains when the market recovers. Of course, you gotta be careful and do your homework. It's not just about buying any stock that's taken a beating, it's about finding those hidden gems that have been unfairly punished by the market. Don't just buy any stock that's taken a beating. Look for companies with solid fundamentals that are being unfairly punished by the market's irrational exuberance, or in this case, irrational pessimism. Look for companies with solid fundamentals that are being unfairly punished by the market's irrational exuberance, or in this case, irrational pessimism. These companies are likely to bounce back once the market stabilizes. Remember, folks, the stock market is driven by emotions, both greed and fear. And during tariff wars, those emotions can be amplified tenfold. The key is to stay calm and make informed decisions. And during tariff wars, those emotions can be amplified tenfold. The uncertainty and fear can lead to wild swings in the market, but it also creates opportunities for those who are prepared. But by understanding how investor behavior shapes the market, we can avoid making rash decisions and potentially even profit from the chaos. So stay informed, stay calm, and remember that every market downturn is an opportunity in disguise. So there you have it, folks, a crash course on how tariff wars can shake up the stock market. We've covered the volatility, the sector-specific effects, and the wild world of investor behavior. Remember, knowledge is power, and by understanding the forces at play, you can make more informed investment decisions. Don't let the fear-mongers and doomsayers scare you off. Instead, arm yourself with information, stay vigilant, and remember that even in the midst of a tariff storm, there are always opportunities for those who know where to look.